everyone, and welcome to another Bitwave Quick Hit. All right, today we're talking stablecoins and business use cases of stablecoins. Pat, let's start with an easy one. What is a stablecoin?
A stablecoin is basically it's an on-chain token. So it is a cryptocurrency. If you've heard of Ethereum or you've heard of Bitcoin or any of those, these are all cryptocurrencies. They are all tokens that are represented on some sort of blockchain that are fungible. So one Bitcoin is equivalent to another one, and you can move them around at will. Stablecoins are a specific implementation of that, which is you have this token, it goes on some sort of blockchain, Ethereum. There actually are some models, but it's hard to do stablecoins on Bitcoin, Base or Stellar or Ripple or any of those. And the idea is that you are that this token, instead of being the sort of, instead of just floating against some sort of supply and demand valuation, which is what Bitcoin is, right? Bitcoin is purely, Bitcoin gets mined and then it is up to the market how much it's worth. And that tends to have a lot to do with, are we at war? How's the petrodollar doing? All these other questions that are out there drive the price of Bitcoin up and down. Stablecoins are one-to-one backed by USD or USD equivalents or a fiat equivalent, because you can have a USD stablecoins, you can have Euro stablecoins, Canadian stablecoins, whatever you want. So the idea is that every time I mint a stablecoin on chain, I create this one token on chain. Somewhere in a bank account or a brokerage account, I have a very, very, very low risk asset that one-to-one can back up that stablecoin. Generally, we're seeing short-term T-bills is the way like USDC and those guys do it. But you can imagine being a kind of anything that you would want. A basket of low-risk funds, mutual funds, bonds could all kind of back it. But the idea is it has to be, quick, like very high liquidity and very, very, very stable so that you are not worried about the underpinning value of that. And then the idea is that I can take that stablecoin. So, we'll talk a lot about USDC today. The company behind USDC is called Circle. I can go to Circle and I can give them $1. I can hand them $1 and they will send me one USDC. And then I can take that stablecoin, I can send them one USDC and they'll hand me back that dollar. So that's their business. And then really their underlying business is they're taking that $1 that I gave them. They're taking it over. They're walking it to the Treasury. They're buying a T-bill, and then they're earning that 3% that you sit on. So you're basically trading, this great amount of flexibility, which is, everything that's great about stablecoins, the ability to move them around instantaneously, move them around the world, all of these, the flexibility. Some of these even earn yield, which we'll talk about a little bit. That's the benefit. The downside is that if with something like USDC, Circle is earning all of the yield that if you had that in a high yield savings account, you'd be earning. So you're kind of making this trade-off between, do I want the yield, or do I want the flexibility and the capabilities?
So what is the best stablecoin for business use?
So it really depends, but let's start at the top here. So USDC is probably the most reputable stablecoin, and they've already been through one challenging period is probably a good way to say it. So when Silicon Valley Bank collapsed and totally screwed over everybody in Silicon Valley and put everyone in a really bad situation, at that moment in time, USDC had about 1/6 of their assets in SVB, and it was not at all clear whether those assets were actually either federally insured or they'd be able to recoup them. So at that moment in time, the value of USDC dropped less than it should have. So like let's say in the worst case scenario that money had just evaporated, they were not able to get it back. Then what it should have dropped is about 1/6 of the fund. So whatever that is, like 20 something around 20%. You basically should have dropped to about 80 cents, because that's what you actually could have been able to withdraw under a fully funded model. Now, because people kind of like there was uncertainty and Circle made some statements and yada yada yada, the prices of USDC only dropped to about 93 cents at its worst. But it kind of like it weathered that storm. They changed their treasury strategy, so I think they no longer have a concentration in a single bank. They moved it across a bunch of different banks instead of different like sweep models and things like that to handle it. So USDC is probably the most trustworthy asset that's out there and the one that everyone knows. But unless you are holding that USDC in a Coinbase account, you won't earn yield on it. Like you have to take your USDC, you have to hold it into a Coinbase account, and then you'll earn yield on it. There are other stable coins. Like one that I love is USDG from Paxos. that actually allows you, that earns yield as you just hold the coin, period. So if you just hold the coin, you're actually going to start earning yield directly into your account on a monthly basis just from holding the coin. So that means you don't have to keep it in Coinbase. You can keep it in your private wallet. You can keep it in, wherever you name it, you can keep the asset there. That is a really powerful thing. So the reason I love that for B2B use cases is imagine a world, where your working capital is basically condensed. So instead of having to like pull out a bunch of money to make your payroll on Wednesday for a Friday payroll, you basically hold USTG until 1 minute before your payroll. So you are earning yield the entire week, past Wednesday, half of Friday. You're earning yield every single millisecond of that day. And then Friday at noon, you send it out to all your employees. And from Friday at noon on, your employees are earning the yield at every single moment after that. This is like the future of crypto, is this idea that we have completely removed the friction, and this idea that there are people in the middle that are basically taking that yield away from you. Because that's what ADP and those guys do. When they take the money out of your account on Wednesday and then hold it for 2 days until Friday, they're earning yield. They're lending it out. They're earning yield. About 50% of the revenue comes from that float revenue. And so that is money that you are paying to them, but you don't necessarily realize you're paying to them. And so if you earn that yield all the way through, that's an amazing. And it also means for bigger companies, they can start making a very real TCO argument. That's a total cost of ownership argument about stablecoins, which is like, yeah, there's, you have to use Bitwave, so it's a little bit more complex. Like there might be some additional complexity around the accounting side, but we're going to earn, our payroll is $1 billion a month. So we're going to earn 3 days on $1 billion of interest. That's literally, that could be $3 million pretty easily. So you can make these arguments about how to actually pay for those, for that. So it's really exciting.
So if a business is using one of these stablecoins for payments, how do they integrate them with their existing financial processes?
Use Bitwave. So Bitwave is it both allows you to make these payments and it allows you to integrate from the blockchain, any activity on blockchain into your ERPs. So what you would traditionally do with in other worlds, if you were trying to integrate your bank account with your ERP, you might use a cash subledger like Kyriba. This is the same thing. If you're trying to integrate stablecoins with your ERP, you use a digital asset subledger, Bitwave, to actually right then, we'll watch all the transactions happening. We can help you actually make payments. So our payments product allows you to take bills or invoices or CSV uploads of payments and fire them all off, and then get those in stable coins or in tokens or whatever you need. Properly price them. So in this case, let's say USDC went down to 93 cents and you need to handle that pricing, handle all the pricing, and get that back into your ERP right there.
All right. Well, there you go. Now we know the best stablecoins to use for businesses. Thanks so much.